Hi, I'm Larry Tabb, founder and CEO of Tabb Group. I'm here with Natan Tiefenbrun, Commercial Director of Turquoise. And the topic for today is going to be about European market structure regulation. Natan, I guess you're looking at the U.S. market. The SEC is kind of investigating almost all aspects of the market. Is this kind of the same thing that's happening in Europe, or what are some of the regulatory things that the FSA and CSER and the regulatory guys are thinking about in Europe?
So something similar is happening. We're in the middle of something called the MiFID review. So the regulators promised when they introduced MiFID that they would come back a year later or 2 years later and look at whether MiFID is proving effective. And so they're engaged in this review. But of course they do also have one eye on the US. So I think the concept release from the SEC, which was such a broad document, I think has triggered the European authorities to ask many of the same questions, some of which I think are applicable in the European context, and others which perhaps they're asking and they don't really make much sense in the European context.
So we've seen, at least from the announcements from the SEC, we've seen things around, making dark pools a little bit more dark. We've been, looking at banning naked access. Are we seeing some of the same outputs, or are we still kind of in the gathering period, the information gathering period?
So the review it has started off with a consultation, which is information gathering, but they are promising to move very quickly towards recommendations. So they've suggested that there's a fairly tight schedule. The review is looking at pre-trade transparency, whether MiFID got that right. Looking at post-trade transparency.
There is pre-trade transparency in Europe yet? In Europe?
Yes.
I guess,
the rules were quite strict, so MiFID.
That's true.
MiFID said.
I guess when we think about pre-trade transparency, we're thinking consolidated quote, and there really isn't a consolidated quote in Europe, even though the market data guys are building one.
Sure. I think in Europe, MiFID said the goal is to create efficient and competitive markets which give good outcomes to investors, and transparency was always envisaged as one of the ends to that goal. And the assumption was that things ought to be pre-trade transparent unless they fell into a number of narrow waivers. And so there were waivers given for large orders where a degree of opaqueness is necessary to avoid price slippage, information leakage. And there was also transparency for price referencing systems, so people offering crossing at the midpoint, for example, where because there was no impact on price discovery per se, therefore having pre-trade transparency wouldn't be necessary. And they're now looking at the balance of that and asking, did we get it right? Because since the rules were written in MiFID, they've kind of progressively tightened the interpretation of those narrow waivers. So there's I think, in response to the debt crisis, they've assumed that transparency must be the answer, and so in the equity markets, which of course I think behaved very well through the credit crisis, they've said, well, for example, dark pools, could they threaten the way price formation and price discovery work in Europe? I don't believe that's true. But I think it's a legitimate question for the regulators to ask as to, what is the right balance between transparency and opaqueness.
So we've seen, I guess, in terms of European dark pools, they work a little bit differently than they do in the States. There's printing at the midpoint. There's very little printing outside the midpoint. It's either like kind of at the midpoint or the NB at the best bid or best offer, I guess. Is there going to be any change there, or do we see any transition there? Now we're starting to see some dark pools register as MTFs. How does that all fit in the process?
Right. Well, so whereas in the US people operate an ATS, an alternative trading system, and they have flexibility there how they trade. In Europe, we have two different regulatory camps. You can be an MTF, a multilateral trading facility, in which case all the MTFs have tended to rely on the price reference waiver, which essentially has typically meant trading only at the midpoint. Whereas a lot of broker-dealers have operated their internal crossing facilities essentially as a broker-dealer function, so it doesn't really have a regulatory badge. And they've had the freedom to print anywhere in the spread, so they're not subject to the same waivers or restrictions. So in the MiFID review, perhaps unsurprisingly, the MTFs and exchanges have been saying the playing field is not level, and MTFs and exchanges should enjoy the same degree of flexibility as brokers enjoy in their
So
non-display
they're looking
trading.
to move outside of just midpoint or bid or offer and
Yes.
some latitude there?
Yes, to have some flexibility to innovate. And I think perhaps a little more surprisingly is that most of the brokers are supportive of that. So I think perhaps because many of them think that maybe one day they will either want to or be required to become MTFs.
Okay.
I think they're very supportive of the regime allowing more flexibility and more innovation, because ultimately, non-display trading venues are there to serve a purpose, which is to improve execution quality for brokers transacting large institutional orders. And the brokers genuinely want the market structures to develop in a way that allows them to deliver best execution. So that I would say there's a consensus amongst most industry participants for greater flexibility there, with perhaps some of the less progressive exchanges being against, and with some of the regulators worrying that whilst it might be good in isolation for a dark pool to have greater flexibility, again this fear that could undermine price formation in the lit markets.
Now, you talked about large and scale. There's this whole idea of crossing around large and scale in Europe that's pretty formalized, I guess, or I guess now it's under review. Why don't you explain a little how that works and difference between large and scale and traditional small order dark execution and some of the issues there? And do you think that that's going to change under the MiFID review, and will it get more stringent or less stringent, or is that still yet to be seen?
Well, so again, so when they said, well, by default, everything should be transparent unless, and two of the important waivers, there were three meaningful ones. The negotiated trade waiver, which I guess we'll leave aside. There was the large and scale waiver and the price referencing waiver. So the large and scale waiver says you can have very large orders can be hidden. But those thresholds were set a couple of years ago before the credit crisis, when equity valuations were much higher, when average trade sizes were much higher. And now with the introduction of MiFID and the introduction of competition, average trade sizes have come down perhaps fivefold.
Right.
Valuations, of course, are lower. And so these large and scale thresholds are in fact so large that today, the minute you bump into a hidden order in an order book, you can immediately infer that the rest of the order must be very big.
Right.
So of course that completely undermines the order type. So usage of large and scale hidden orders in lit books is very low, precisely because by definition you're not protected against market impact, because the minute a print goes up at the midpoint, everybody knows it must be a large order.
Large and scale, and everybody rushes in.
So that regime, I would say, is essentially it shoots itself in the foot, and I think people are lobbying across the board for lower thresholds, where perhaps the information leakage when somebody bumps into a large and scale order will be less meaningful.
Do you think we'll see something out of that, or is it still yet to be to be determined?
I think, first of all, it's definitely yet to be determined. We're in the consultation phase. I guess I think the regulators will hear pretty consistently from all market participants and market operators that number's way too high. The regulators also ask the question, which is, in the price referencing waiver, trading at the midpoint, should it also be subject to a minimum size threshold? And we operate now what is now the largest such venue in Europe. So it's only been the largest for a couple of weeks, but we're delighted to be there.
Take the medal when you can grab it, right?
Make hay whilst the sun shines.
That's
exactly.
Right.
But we're against that. We think that we provide facilities for participants to set a minimum acceptable quantity on their orders. And we absolutely encourage people to use that, but we don't think it makes sense for the regulators to come in with a number and say that's the minimum, because in reality, as the large and scale debate proves, they can only be wrong 12 months later or 24 months later.
Right.
So we provide this midpoint non-display matching facility to be used by brokers for their institutional flow. These are these institutional investors, these are professional broking firms pursuing best execution. And we think that they do and they ought to know how to use the market to the best advantage of their customer. And we don't think that the regulators need to protect anybody. I don't think there's any danger here. Again, I think the consideration for should they put a minimum size there is because otherwise might too much of the trading go dark. And again, I don't
price reference.
Well, I don't believe there's any danger of that.
I don't think so either, actually.
I think the key thing is that our non-display midpoint venue. I'm avoiding the term dark pool because the word dark scares European regulators and politicians and possibly the public. but we print those trades to the tape instantaneously and clearly identify them as being midpoint, non-display trades. So they do contribute to price formation immediately after the fact. And I think one of the, in post-trade, I point out a difference between an MTF and how it trade reports. And, it's very clear, it's a midpoint book, and that's what that trade is, and everybody understands there was both a buyer and a seller there.
Right.
The brokers in their crossing networks, when they report trades, they're required to report the trades as near to real time as possible. But those trade reports are commingled with everything else that's going on in the OTC space. So if you're looking at the post-trade reports in the OTC world, it's impossible to tell the difference between an agency cross, 2 client orders meeting at the midpoint, and an obscure OTC contract being exercised. And I think there's a difference between some market participants calling for an improvement to OTC transparency, for example, differentiating between price forming electronic transactions and something more manual or more exotic. And you've got people calling for, as the SEC has, for fully attributed real-time reporting. So this trade happened in broker X's dark pool, this one in broker Y's dark pool. And our opinion at Turquoise is that we don't need to go to that fully attributed model. I don't see why that should be relevant to the broader market for price formation.
Right.
But saying which trades were essentially electronically, automatically executed, and liquidity that you might have interacted with had you been in the right place, I think and therefore you should think about it as relevant to price formation. I think that would be helpful.
Yeah. Well, I think with that, we'll call this a wrap. I'm here with Natan Tiefenboom, Commercial Director for Turquoise. I'm Larry Tabb, Founder and CEO of Tabb Group, and we'll call that a wrap. Thanks.
Thank you.